G'day everyone, welcome to the weekend general update for the 18th of August. And I've been pointing towards the fact that we would get a correction starting sometime late August, September. That would appear as though it started in the last few days with a pretty sharp move down in the US indices and breaking of short-term support. So looks like we're into the corrective phase already, and we'll have to see how that plays out. Based on normal cycles, it should last somewhere between 2 weeks and perhaps 6 weeks, and we'll just have to assess day by day how it's unfolding. So let's have a look at the action from last week. The S&P ended up down 36 on the week, so fell sharply on Thursday, and then a little bit of follow through overnight as well on Friday night. So the short-term trading range that we've been looking at for some weeks has broken, and as you'll see from the chart, I've got downside targets between 1465 and 1570, and I suspect that which level that gets down to will depend a heck of a lot on any announcements from the US Fed regarding tapering of QE3. Now, short term, we've had a sudden move down. We might see a little bit more downside in the next day or two, but I do expect to see a mild rebound next week, and then probably a sharper decline after that to complete the correction. So let's have a look at the S&P. So if we wind back and have a look, we've been having a terrific run that really started in June of last year, but more specifically, since the last time we had any sort of meaningful correction was really November. So you can see we had quite a strong run up. We got the first sign, so you'll notice this red line here is the 50-day moving average, so shorter term moving average than what we normally look at. And prior to the period in late May, June, the index had stayed above that short-term moving average. June was the first time that that moving average got breached, so that was just our first warning sign that we were perhaps coming to the end of this particular run. And that's why I think now we're going to see a correction of the bigger level. Up till now we've had mild little corrections of each of the shorter term moves to the upside. So I've moved to the upside, a week or so to the downside to correct it, then another move to the upside, another week to correct it. This time I think it's reached the point now where we'll see a larger correction, and there's several time frames that we can look at this under. We can draw out a retracement framework using the 15th of November as the low. We could come back a bit further and use the 5th of June last year as the low, or we can go back to October of 2011 as the low. So depending on which one you use, we get targets anywhere from around 1465 up to around the 1570 mark. 1570 brings it back to just below the 150-day moving average, probably pretty close to the 200-day. By that stage, the RSI will be well and truly unwound and oversold. So I think that's the areas that I'm looking for. So depending on how it gets there, will tell us a little bit more about the actual depth of the correction. So you can see the move was sharpish on Thursday. It wasn't as big as what we saw in June. The one in June came about because there was direct comment from the Fed that they would be starting to wind back QE3. The move on Thursday night was not really any announcement from the Fed, but it was the conclusion of the market because the economic data had improved, that the market started to think, well, that's a done deal, that they'll start winding back QE3. So it's still all conjecture at the moment. It may not happen, but what I would expect to see, which would be perfectly normal, would be a 3-phase move to the downside. So that would be a correction within an overall uptrend. So we may have a little bit more to go on this. I'd then expect some sort of mild rebound, perhaps to retest the support level that we had around the 1675 area, and then we get the main part of the move to the downside. So I think that's how we'll see this play out. And this final leg here, this is our A leg, B leg here, rebound to the upside, and then the final C leg to the downside. And that C leg itself is likely to play out in a bit of an ABC pattern as well. So within that, we're likely to see something that looks like this. Just to give you an idea of how this is all likely to play out. So I think we'll get a series of moves that form that sort of pattern. So depending on how quickly it all occurs, anywhere from 2 to 6 weeks I think is the time period that we're looking at. Now you'll remember that I've been looking at the Russell 2000 very closely, and there was a bit of a sharp move on Thursday night, but it's still well above the 150-day moving average, starting to unwind. But yeah, when I really look at the whole overall setup, I think there's certainly capacity there for this to be a correction of a bit more substance than what we've seen this year. Now the other key indicator that I've been looking at is the 30-year Treasury interest rates, and I said a few weeks ago that if they got up above 4%, that would be a bit of a poor situation for the stock market. It would be a real concern for the stock market, and you can see on basically last week, interest rates continue to push higher, and in fact hit almost hit 3.9% on Friday night. Now that must be a bit of a concern for the Fed, because that immediately flows through to mortgage interest rates, and we may well see the Fed try and do something about that to try and slow it down, and again that would be quite positive for the stock market. So a lot of things do depend on Federal Reserve announcements, which makes trading just that little bit trickier, and that's why it's important at this time of year to pull back and basically reduce your exposure and just see what happens. Now moving on to the Australian market, our index gained 59 points on the week, so a much better week here, and the big resource stocks were the main contributors. Finance index was down a little bit, but it was really this turnaround in commodities and global resource stocks that has helped our market. We've got a much higher proportion of resource stocks in our index than the American ones do, so that's why there's more of an impact here. Now we saw a remarkably resilient performance on Friday in our market, particularly in the small and mid-cap stocks. In fact, the Small Ordinaries Index actually rose on Friday, so that was an excellent performance, and really really underpins the strength of that part of our market. Now gold spiked higher by $57 on the week, broke resistance. The key level I was looking at was $1,350. It broke through there and managed to close pretty close to its high of the week. So that was really quite important, and that now I think pretty much nails it that we've seen the bottom in the price of gold. Gold stock indices confirm the base that they've been forming, but in the short term they're a bit overbought, so don't be surprised to see gold stocks pull back a little bit globally. And just remember that this process of basing, particularly when it's on a big picture level, and gold stocks and mining stocks have been heading down now for the best part of 18 months, that process of basing occurs over a period of time. There's a multiple number of lows get formed, and it's not a single day event. It doesn't just run down and then turn around and go back up again. So basing is definitely a process. So don't expect miracles. It takes a while until that momentum builds up. Let's have a look at gold and the gold stocks. So this is the gold chart on a weekly basis. So you can see we'd really got tremendously oversold and quite a nice rebound. So we've had an initial move to 1350, We pulled back for 2 weeks, and now we've broken through that 1350 area here, which was this was a reasonably important area to break through. Getting back above the highs of the week ending the 26th of July was technically important, so I think we can look towards gold continuing to head higher. It's still got quite a way to go to get up to overbought. Now silver also had a really good week last week. In fact, outperformed gold significantly, and silver's up by nearly 20% on its lows. So silver looking very, very good indeed. Let's just check the gold indices. This is the GDX, and despite the fact that gold went up on Friday night, the negativity of the market weighed on the gold stocks themselves a little bit. They'd also almost reached overbought, so just a little bit of selling pressure. This is the GDX, but looking very robust indeed. Now let's just have a look at the division between the gold price and the GDX index. You can see now, for the first time, we've now formed higher highs. Or beg your pardon, we did actually do that here in September last year, so we still need a bit more to the upside. But look, it certainly looks more like a base to me now than what we've seen before. So things looking pretty positive for gold and gold stocks. Copper also rose to $3.40. So really, there's a lot of signposts pointing to the fact that that resources have turned the corner. We've got iron ore prices up above $140 a ton again, so it's pretty hard to be negative on the sector now, and stock prices are starting to catch up. Oil rose to $107. That's largely on the unrest that's happening in Egypt at the moment. And this is the spot chart for copper. So you can see we got down to about 305, and it's rebounded close to $3.40 on Friday. So quite a strong rebound there. So just to wrap up from a strategic approach, US markets in correction mode. The odds favour, not an overly severe style of correction. I don't think we're going to see what we saw in 2011 and 12, those really sharp moves. And the two target areas I've identified as between a correction of between about 8% and maybe as much as 15%, but I'm a bit doubtful on that. And then I would expect to see a resumption of the uptrend into year end. But as I indicated before, it does depend very heavily on what the Fed does in terms of QE3. My feeling still is that they will not do it this calendar year. I think they'll talk about it, they'll intimate it, they'll hedge their bets, but just trying to keep a lid on the market. But I think at the end of the day, they won't do anything this year. It'll start sometime in 2014. So the very best stocks still making gains. We've had a terrific year, and the fact that so many of our portfolio of small and mid-cap stocks actually either held ground or actually made a profit on Friday is a very good indicator. So from a strategic approach, this is a time to wind back exposure and sit through this correction and make sure you're well positioned for the bargains that are coming. That's it for this week. Cheers.